all seasons in the same time period was just a negative 1.63%. Okay, so when we talk about asymmetrical risk reward, you know, and making sure that your odds of winning are in your favor, and when you lose, you're not losing a whole lot, that's what I'm talking about. Okay, that's what you're looking for. So now, a lot of this is done through diversification. So let's go into the diversification real quick for the all seasons portfolio. So number one, and we're going off of, I actually went in and individually selected some of the stocks that I'm going to show you here. So they're pretty much, I'm not going to say that it's exactly what you need to do, because it's not. Your situation may be different. You may have more money than me, so you may want to buy into different funds. But this is what I'm doing right now, because I don't have, I don't have a couple $100,000 to invest realistically. So I'm just starting this long-term approach. So keep that in mind. All the videos that I've shown you in the past have always been like short-term for day trading, growth stocks, dividend investing, stuff like that to create passive income. And this is more for building my nest egg so that I can, I don't run out of money before I die. Okay? So this is the other portion of investing. It's the long-term approach. So number one is you want 30%, okay, in stocks. So basically what I did is I broke it down, and we'll just abbreviate here. So it was, I did 10% in, say like the Vanguard. That's the, the Vanguard 500 index. So 10% of 30% of whatever I'm investing. So let's say you got $10,000, right, to invest. That's your total amount. 30% of that 10,000 needs to go into stocks. Okay, now you break your stocks into 10%. So 10% of the 30% would go to Vanguard index. So 30% of 10,000 is what? Is it like roughly $3,000? I don't have a calculator on me, but I think that's about right. $3,000. So 3,000 goes into stocks. 10% of that 3,000 goes to Vanguard 500 index. And then we have another 5% going to international. Oh, I'm sorry. It's going to be 10%. 10% in international. So you want to stay, you want to have some of your investments outside the United States, okay? Because the United States isn't always going to be the top dog when it comes to some of the different energy sectors or markets that are out there, okay? So you want to increase your odds, right, of getting better returns. So you need to look outside the United States as well. It's not a bad idea. And I shouldn't say you need to, because you don't have to, but it's highly recommended by the world's brightest financial investors. So why not do it? If they're doing it, don't you think you should probably do it too? So 10% goes to international, and then 10% goes to emerging markets. Alright. Now again, I can throw some of these stock symbols out there for you. Probably what I'll do is put some of them in the comments below this video, because I don't want this video to run too long. And I could really break this down and make it complex and hard to understand for you, just writing it out. So I'm going to probably put some of that in the comments below. this video so that you kind of know what I'm doing. These are stocks, again, that I'm picking. So it doesn't necessarily mean you need to go pick them too. You need to do your own research. And I spent probably about, I don't know, roughly 4 or 5 hours probably researching some of these different stocks, picking the ones that I wanted and what fits my situation financially. You probably should do the same thing. Alright? So 10% goes to emerging markets. And with the international stocks here, guys, there's 2 different stocks that I picked for that. And of that 10%, I broke it down into 5% on one, and then 5% on the other stock. So I did a 5%, 5% on the international. There's 2 stocks for that one. In the emerging markets, I have an ETF, okay, and it's 10% on that one. So that's your stocks, guys, right there. Now, the next diversification is you want 40%. So 40% of $10,000 on your initial investment will be another $4,000. You want that in long-term U.S. bonds, okay? Something like the Vanguard Long-Term Bond Index Fund, all right? 40% goes there. And then number 3 is you want 15% in intermediate U.S. bonds, okay. I chose Vanguard for that one as well, okay, because what you're doing here, in my last video I talked about low fee and low cost indexing. What you're doing is you're indexing in all these. So you're becoming the market in every single category. So you're becoming the market in stocks, you're becoming the market in long-term U.S. bonds, you're becoming the market in intermediate U.S. bonds, okay, so that you're diversified. That way you're not doing what I experienced in my short-term investing, where you're losing all your money because you have all your eggs in one basket. Okay, you can have all your eggs in one basket, but you have to watch that basket. You have to do the same thing here. You have to watch the basket. And what I mean by that, with something so diversified like this, what you want to do is rebalance your portfolio. They said at least 6 months to once a year, and I'll make another video on rebalancing a portfolio and kind of how you do that. Alright, so if you're curious how to do that, that's for another video. So getting back here to the last 2. Oh, let's see here. We got number 1, number 2, number 3, number 4. You want 7.5% of your initial investment. You want it in the commodities. Index. Alright, that's number 4. I gotta get down here so I can write this last one out, because this is number 5. You want 7.5% of your $10,000 investment, and that's just an example again, that 10,000. Your number could be different, but you want 7.5% in gold. Okay. Now I chose for gold and commodities, I chose Vanguard on those as well. I indexed them. So I've got Vanguard Materials ETF, and I've got a Vanguard Precious Metals Fund. Alright? But that's what you want to do, guys. You want to diversify like this, and the reason why is you're looking at this going, why am I going to invest in like U.S. debt? Because that's what bonds are, or U.S. debt. Why am I going to do that? Well, you're diversified, and the thing is, long-term U.S. bonds and intermediate U.S. bonds, you've got long-term and you've got kind of mid-term with U.S. debt. Okay, that stuff has to be paid back. And if it's not paid back, your government, you really don't have a government, per se, if that happens. So it's pretty much, bonds we'll cover in a different video, so I'm not going too long on that, but basically what you're doing is securing some of your money in safer, lower risk investments. Now, see, again, looking at this, it's not all in that. You know, it's not all in long-term U.S. bonds, intermediate U.S. bonds. Part of the problem people have with investing is, you may have heard the term having a balanced portfolio. Okay? Now, most mutual funds will go 50-50. So they'll go 50% stocks and then, 50% in bonds. Okay? You would think that's balanced, right? Well, it's not, because if you read the book, or read some of the other books that I've read on asset allocation, you'll find out that 50% stocks, if you had a balanced portfolio and you had 50% of your money in stocks, realistically, the markets, we all know, go up and down, correct? So if they go up and down, if the markets go up and down, they're volatile, which means there's risk, okay? Now, if you remember those numbers that I ran by you out of my phone there on the last 75 years of performance on this versus the S&P 500, you know that the S&P 500 has an average loss of about 11%, right? If you're 50% in stocks, you're probably, the markets will lose 11%, but you're probably going to lose a whole lot more than that, okay? Statistically, going out of the book, they said if you got 50% in a balanced portfolio in stocks, realistically you're setting yourself up for about 90% risk. And if you got 50% in bonds, you're 10% risk there. All right. So what this does is it diversifies you, and it lowers that risk tremendously for the amount of money that you're going to lose. Because the name of the game is to keep your money, keep as much of it as you can. That way you don't have the problems that I was talking about in the beginning of this video with, like, the challenges, inflation, low returns, not matching the S&P 500, and, excuse me, what was the other one? 96% of mutual funds not matching the performance of the S&P 500, okay, along with high fees and inflation. Those were the three. Sorry, I had to think about that for a second. But you want to stay diversified so you can, like I said, fight those challenges, so you're not running out of money, all right, in your retirement and going back to work, like, at the age of 70, 75 years old, all right? So hopefully this helped you guys out a little bit, knowing what it's about and where to break down your money. I'll make another video later on some other stuff that I have lined up for you. Until then, guys, stay tuned, keep working hard, take your money, and pay yourself first, all right? Peace.